My name's David Clift. I'm from Hazelwood's Accountants in Gloucester. I work in our innovation team in our Gloucester office, and a large part of the work of our team is not just assisting innovative companies with their accounts and tax work, but more specifically with the tax breaks that are available for innovation, so R&D tax credits and the patent box. So what we're going to spend this session doing is having a quick look at how those work. I realise that some people might be reasonably familiar with those already, but hopefully we'll be able to look at those in a slightly different light and possibly pull out some practical tips and things to think about how to deal with those. And we're also going to cover the patent box, which is the new tax incentive for innovative companies. How that works, again, points to bear in mind as you're looking at that. So we're going to kick off with the R&D tax incentives first of all. Now, these tax incentives have been around for quite some time now, actually, since the turn of the millennium. And so it's quite surprising that even this far in, we still come across quite a few companies that don't fully understand how they work, or there are certain misconceptions as to how they work. So for those sort of reasons, I suspect the take-up of them hasn't been quite what the government had hoped. And because of that, the tax incentives have ramped up quite considerably over the years. So they are now worth a very valuable cash injection, really, for innovative businesses and any company that's looking at doing research and development type work. So what do we mean by R&D then, purely from a tax perspective? I think a lot of the reason why people rule out R&D tax incentives is because they have this notion of what R&D is, and sometimes they assume that it's high science, it's really for pharmaceutical companies and so on. But actually it's much, much broader than that. And most of the businesses that we work with tend to be in things like manufacturing, engineering, software, and so on. So from our perspective, R&D, the definition of it really relies on three key points. You have to be able to identify a project, which most companies are aware of when they're working on an area of work. They can define that as a project. But that project needs to be aiming to achieve an advance in technology or science, and through the resolution of technological uncertainties. Now that all sounds a bit highfalutin, but really what it comes down to in practice is what we're looking at is companies that are developing new products, processes, ways of doing things, devices, where the solution isn't obvious to somebody that knows what they're doing in that particular area of engineering, manufacturing, whatever. So if we can identify those sort of activities within the company, what is the tax relief then? Well, again, another reason why I think the take-up has probably been poor is because it's got the word tax in the title. And let's be honest, tax isn't the most inspiring of things, even for those of us in the accounting profession quite often. So it's quite a turn-off for people, but really the way to think about it is it doesn't actually work in many ways like a tax incentive. It works more like a rebate of costs that you've incurred in pursuing those sort of activities. So there are two schemes, and the broad thrust of these are that if you're doing work where you're incurring expenditure on that sort of R&D activity, possibly by actually outsourcing that activity to someone else, or if you're actually doing the R&D, but possibly having that funded from external sources, or a mixture of both of those, then there is potentially something in the tax break for you. So other reasons why the take-up might be low, well, there are some fairly common misconceptions that we find when we're talking to companies about this. So the typical ones are, well, we're not a high technology company. As I say, people tend to assume this is one for the pharmaceutical companies, and it really isn't the case. Any company that is doing some sort of innovative activity, be it development of new products or processes, or just looking at the internals innovation of their business. So we might make the same product, but in a substantially different way. We might be looking at manufacturing efficiencies and doing things with a slightly different technology to improve the way that we do things. All of these are areas that can be innovation that qualify for the tax break. We don't have any new products. Well, as I say, that product isn't the sole focus of this tax break. If you're inventing new processes, new technologies, looking at using new materials, all of these things can be R&D from a tax perspective. Our R&D is paid for, so we can't claim, is quite a common one that we hear. And it sounds logical, doesn't it? Well, if we're not bearing any cost of it, why would anybody give us any money towards it? But that isn't quite the way that it works, and we'll come on to that shortly. We can't claim because it's all done for other people. Again, it sounds quite logical, doesn't it? You know, it's not our R&D, it's for somebody else. But even if you're in that situation, there can be circumstances where you can still get the tax break. We don't have detailed records of R&D time and costs. I had this exact conversation with a company that I went to see on Monday, and the same thing again. Well, we haven't got the records to support it. Well, you don't necessarily need the level of record keeping that you might think, particularly in the early years of making a claim. So don't let that put you off. And as I say, it's quite broad. So here's just a sample of the sort of businesses that we tend to find are claiming R&D tax credits. As you can see, they're pretty broad. Food and drink, for example. A lot of people have said to me, well, there can't be any innovation in that. It's a food or drink company. Well, it's similar to your situation that you outlined, Vicky. There's packaging that's involved in the food industry, where there's a lot of innovation that goes around that to keep the food fresh, to enable it to be delivered through vending machines and so on. So, who can claim it? Well, it is companies only. It is something that's delivered through the corporation tax system. So it's just companies. And there are two schemes of relief, and I think a lot of people have heard of the terms banded around the SME scheme and the large companies scheme, but they're not quite that. What they are is two different schemes, one which focuses on who bears the costs of the R&D, and it rewards companies that bear the costs. And now that scheme is by far the more beneficial, but it is only open to SMEs, which is why people call it the SME scheme. The other scheme is the scheme where you might not be bearing the cost or the risk of the R&D, but you're doing the work. That scheme isn't quite so beneficial, but it is the only scheme that large companies can claim under. SMEs can also claim under that scheme if, for some reason, they don't qualify under the cost-based scheme. So, for example, if they're having the work funded. So what do we mean by a SME for these purposes? Well, again, the definition for this is much broader than people imagine, because in essence, you're talking about something that can be twice the size of an SME for other purposes. So a business with up to 500 employees and a turnover of up to 100 million euros would still be an SME for these purposes. So we're talking some really substantial businesses, and the vast majority of the businesses that we work with are in that SME bracket, albeit that some of them we're claiming under the other large companies scheme. So what's it worth? Well, unusually for an accountant, I'm going to try and cut through the maths. In broad terms, as I say, it works almost like a subsidy or a rebate. And what's that rebate worth? Well, for companies under the SME scheme, you're really looking at a subsidy in the region of about 25% of the qualifying expenditure on the R&D. And this is in addition to any deduction that you would have from your profits ordinarily in calculating your tax, which is why I say it really is like a rebate. A new development here, which sort of slipped under the radar at the recent budget, or the last budget, is that for companies that don't pay tax, possibly because they've got tax losses, those companies can actually surrender those losses and cash them in for cash from HMRC, which is why I say it's not really a tax incentive as such. It's more like a rebate. Even if you haven't paid tax, you can still get some cash out from it. And for those companies in that position, the rebate is from 1 April this year is going to be worth almost a third of their costs. So quite a lot of money at stake. The large companies scheme, you can see I've fallen into the trap myself of calling it a large companies scheme. This is the scheme for the activities. It's not as beneficial on the face of it, because you're only getting 6 to 8% subsidy. But if you put this in the context that actually maybe all of your R&D activities have been paid for, you're not bearing any cost at all, having another 6 to 8% of the gross costs injected into the company as cash from HMRC can be pretty worthwhile. This scheme is changing as well. This is really an acknowledgement now that it is a subsidy, because from 1 April 2013, companies claiming under this scheme can elect, instead of actually running it through their tax computations, can actually say, well, I've quantified the expenditure, I would like a 10% credit from HMRC, please, but that 10% credit is subject to tax. So overall, it's going to be worth in the region of about 8% of the costs. Now, that really is a rebate, because even in your accounts, you reflect that as income pre-tax in your accounts. So it's nothing to do with the tax situation at all. So we've identified that we've got a company that's doing the right sort of activities. We think we've got an idea of what scheme we're going to claim under. What are the costs that can be included in the claim? This is pretty much the defined list. So if you don't want to get an inquiry when you make your claim, don't include things like rent and rates or proportion of our overheads outside of certain parameters, because the Revenue have indicated in their own guidance that that's probably number one on the list to get you an inquiry as to how you've put your claim together. Because if you can't get the expenditure right when they've actually given you a defined list, then the question that goes through their mind is, well, what else have you got wrong? So this is the defined list. I don't think there's any big surprises here. It's the costs of the staff who work in resolving the uncertainties, resolving the issues, the technology issues. It's also staff involved in certain supporting activities. So this would include people that are involved in recruiting people in for that project, managing the finances of the project, maintaining the equipment for the project, and so on. Even if you haven't got people on the payroll and you pay an agency for these for individuals' work, and that third-party provider invoices you for the costs, you can include that as well, to the tune of 65%, because the invoice costs will include an element of profit for the staff provider. So an arbitrary 35% is deducted. The software that you use in your R&D can be included in the claim. The consumables used up in your R&D activity can be included in the claim. Costs of putting the prototype together. If you're using that prototype for testing whether the technology works, you can include those costs. And in certain situations, if you pay somebody else to do the R&D, you can include 65% of that cost too. So, for example, we've got a situation where we've got a company that does 3D barcoding for the healthcare industry, because they need to track all of these implements and so on. They use a software company for the software-hardware interface. They don't do software themselves, so they outsource all of that work. Because it's an SME that we're preparing the claim for, they can include 65% of that cost in their claim. So as you can see, the additional tax relief really comes through from some of these annual costs that flow through on an annual basis. So what happens with equipment then, if you incur costs of equipment to do the R&D with, or buildings? Well, you don't get the additional tax relief, but there are special tax allowances where potentially you can get tax relief more quickly. Or in the case of buildings, if you own the R&D building, or you might have purchased a building for the R&D activity, to the extent that it's used for R&D, you can get tax relief, 100% of that relevant cost in the year that you incur the expenditure, which is the only way nowadays in the tax system that you can get any tax relief for the building whatsoever. So a lot of companies that we work with, one of the questions is, well, where are you doing this R&D? And there's a company not too far away from here where we've looked at this, and they've got a big site where they've just put a huge extension on, and we were looking at it with them as to whether they could get 100% tax relief on the cost of the extension. So how do we go about claiming it? Well, the only reason why it's really called a tax credit is because you do flow it through your corporation tax return. But when you look at the corporation tax return, there isn't a form in there that you fill in to explain how you've collated the expenditure. There's a sum total of about 2 boxes that you put a number into. Now, if you leave it at that and you send your tax return in with a figure in that box into HMRC, then you are pretty likely to get an inquiry on how you got there in the first place. So most companies, as well as filling in that box, provide a document to go with their tax return which explains how they've collated the costs, what the R&D activities are, explain how they meet the criteria for it being R&D, and then actually show the calculations of how you've got to the number that you're including on the tax return. So how long do you have to do this? Well, in essence, the way that the company tax system works is that after your company's year end, you have a year in which to file your tax return, and you have another year in which to amend it. And that amendment could be to include an R&D tax relief claim. So potentially, you can look back to expenditure in the last 2 to 3 years and claim on that. So, for example, if we've got a company with a year end of 30 June 2012, we'll be looking at expenditure in that year as to whether it qualifies as R&D. So expenditure from 1 July 11 to 30 June 2012. And if we want to make that claim, then it's going to have to be in within the next fortnight, 30 June 2014. The presentation of the claim is very, very important, and the approach that you take is very important as well. In some cases, it can be appropriate to get HMRC in and to have a meeting with them to explain how you've put it together. But the vast majority of cases, you will simply put a document together, as I say, explaining how you've done it, making sure that it's presented in such a way that it ticks the boxes for HMRC, and then the claim will go through, hopefully without inquiry. So, quick example of how this works in practice then, and what a claim might look like. This is based on a real example of a project that a company undertook. The company was in, they're in direct marketing activities. So they put a lot of, they're the ones that are largely responsible for all that gumph you receive through your letterbox, all put together. And surprisingly enough, when you receive your envelope with your personalised information in, actually, the way that that's put together is often out of one sheet of paper, printed right the way through from start to finish and folded and assembled and glued together in different ways through the machinery. Now, what this company was looking at, therefore, the way it makes its money is to make that operation one process and as slick as possible. So they're always looking at ways in which they can make it faster, more efficient, use different materials, different techniques and technologies. And this particular case, they were looking at whether they could change the sort of glue that they use in order to speed the whole process up through the machines. So they were looking at new formulations of a glue. There were issues with this, though, because they tried different formulations on a number of occasions and the thing fell apart. They tried different formulations and the thing stuck together and you couldn't open it. All of these sort of issues. Issues with the way in which it worked on the machines. They had to make changes to the machines and they didn't know exactly what they were going to have to do there. Issues with how it reacts with the specialist papers that they use. So they had to undertake a whole project on looking at the different formulations, trying them out, getting specialist advice in, working with different prototypes and so on. So this project actually qualifies, and we've had a long meeting with HMRC to talk through a whole load of projects, and this was one that they agreed was R&D. So I've obviously changed the numbers, and I'll tell you what the real number was that crunched out of this claim at the end. What we did was collated various costs, so the staffing costs. So we've got 2 individuals in this company on salaries of 40k and 60k respectively, spending 60% and 50% of their time on this activity, on aspects that required resolution of the issues. So when you crunch those numbers down, you come to a total of £54,000 that we're including as staffing costs. We used some specialist advice and brought those guys in from a third party to work alongside our engineers to help with the formulations and so on. Paid an invoice to the provider. So that invoice was £60,000, so we can include 65% of that, £39,000. And then, of course, we've had to run it through the machines. Power and water costs have incurred. The prototypes, putting the actual prototypes together, so an extra 7,000 of those. And to keep the maths nice and easy, by sheer miracle, that comes out to £100,000. The way that the relief works is you get 125% extra tax deduction. So let's say that our taxable profit before we did this exercise was £190,000. We take the extra deduction of £125,000, brings our profits for tax purposes only down to £65,000. So our reported accounting profit is exactly the same as it was, but our taxable profit is considerably less. So assuming a tax rate of 20% on that, tax liability before would have been £38,000, tax liability now 20% of £65,000, £13,000. Tax saving, £25,000 on the strength of £100,000 of expenditure that we identified, 25%. For a relatively easy exercise, quite a lot of money. The real number that we had for this company, just to put it in context, was they had a whole load of projects like this, and we ended up agreeing a tax rebate for them of £250,000 from HMRC, which went through on the nod on the strength of a 2-hour meeting. Let's suppose we've got a company that's actually reporting a tax loss though, so it's not paid corporation tax. Keeping all the figures the same, uplift the same, but let's say that that loss that it had was £150,000. So that £150,000 is effectively £100,000 of the R&D and £50,000 of other. Well, what we can do here is we've got the £225,000 to do with the R&D. So the £100,000 that we've incurred plus the £125,000 uplift. And since 1 April, what we can now do is actually surrender that for 14.5% cash of that figure, which gives us a tax rebate of 32,625. As I say, almost a third of the expenditure that we identified. So we haven't paid any tax, but HMRC, in their kindness, are going to give us 33 grand back. So a lot of money. So as you can see, it's quite a valuable relief, but the sort of queries that we get in practice tend to be around, well, how does it actually work, and can we claim on this, and so on. So here's some typical ones. We've got grants. Vicky mentioned earlier on various sources of fundings. How do those interact with the R&D tax rebates that we're going to claim? Well, in a couple of ways, really. Firstly, who thinks it is going to affect us? I've sort of given the game away. Show of hands. Who thinks it's going to change the R&D tax position? Who doesn't think it's going to change it? Oh, right, and a lot of abstentions. Right, well, it does affect it. It affects it because, in the sense of which scheme you're going to claim under. Because, as we said, there's two schemes. One of them is based on companies bearing the cost, and the other one is companies doing activity. So if we've got a company that's doing activity but no longer bearing the cost, because it's had some funding towards it, then that funded cost, for starters, is going to be in the other scheme. So we're not going to get the most advantageous R&D tax credits position. It also affects us even more greatly if that funding is a notified state aid, such as a TSB grant, for example. Because in that situation, the more favourable scheme of R&D tax credits is itself a state aid, and you can't have two on the same project. So that particular project, you would have to ring fence and identify the costs separately, and that whole project would have to be claimed under the large companies scheme, the 6 to 8% rebate, instead of under the SME scheme. But it would only be for that project, so it's important to focus on where you draw the line. Where does the R&D start and end? And this is very important to shape up for HMRC, because usually if they're going to inquire into a claim, it's, well, where have you drawn the line? What have you claimed as in and what have you claimed as out? In broad terms, if you're just looking at the current state of the technology that's available, that's out, because you're not actually solving any uncertainties and looking to advance the technology. Once you know what the state is and you realise that there's a gap there and you therefore need to develop something yourself, and you don't know how to do that, that's R&D. But when you've resolved those issues, then obviously it's no longer R&D because it doesn't meet the definition anymore. What about if the business owners pay themselves as dividends? Is that going to affect things? Yeah, pretty common one. It is a bit of a problem, because staffing costs are exactly that. Money is extracted from the company to pay people as employees, So if you've got a business owner that's paying himself as dividends, that's not him paying himself as an employee, that's him paying himself as an owner of the business. And that doesn't qualify. Now, if you've got an owner who happens to spend almost all of his time in R&D, then it can actually be more tax efficient, potentially, to take that money out as a salary rather than as a dividend, because the pendulum swings in terms of the tax relief and the effect of it. Okay, so we started work on a development project, but it didn't work. Can we claim tax relief for that? A lot of companies think that it's, you wouldn't get a reward for failure. We're only going to be able to get it if the things worked. Well, that's not right. It's the intention of why you're doing it. So if it was seeking to achieve an advance in technology, then you can claim. How much evidence do I need? As I said, this is that query about, well, we haven't got the timesheets and so on. Well, actually, HMRC do operate quite a reasonable light touch when you first venture into R&D tax credits. And they're quite accepting of you coming up with a reasonable percentage of people's time, for example, without any timesheet records. But what they expect you to have done is to have a look at which individuals were involved in which projects, at which times, what were they doing, and so on, and come up with something reasonable. What they do usually want to see, though, is once they've let you have a couple of years or a few years' worth on that basis, they want to see that you're doing something to put something in place to actually give you some support for the numbers that you're claiming. We started work on a project, but it had to be shelved for commercial reasons, presumably because we didn't do anything with it, we can't claim R&D tax relief. No, not correct. Doesn't matter what you did with it in the end. As I say, it doesn't matter if it didn't work or if you shelved it, whatever. If you incurred the costs with that intention and that motivation, then you could claim. So that's a quick whiz through the R&D tax incentives. The new tax incentive that we've got for innovation companies is called the Patent Box. And why did this come about? Well, the R&D tax incentives, a lot of companies were finding that quite useful, and we're all supporting, as taxpayers, this innovation activity by UK companies with a view to effectively getting new products that are going to make money for the UK economy, which is all going to be great for us because we'll take tax on that, on those profits. Well, that isn't quite what was happening. We were all supporting the R&D activities, and then a lot of companies were offshoring their IP in order to take advantage of more favourable IP tax regimes in places like Belgium, Luxembourg, trying to think where else, Malta. So what the government said was, well, we need to do something to combat that. We'd rather have some tax at a lower tax percentage on some profits rather than a higher rate of tax on zero profits that have gone offshore. So what they did was they introduced a patent box for the UK tax system, a 10% tax rate on profits, on the extra profits that you make from your patents. So, as I say, it's a reduced rate of tax. The idea is it's going to be a 10% tax rate on the extra profits that you make from the fact that your product is patented. And I say extra profits because a lot of people are pushing this around saying, well, all the profits that we make, because all of our products are patented, all of our profits are going to be subject to tax at 10% corporation tax rate. That isn't quite the way it works. There is an expected normal profit that you will make that will still be subject to tax at the normal rate. It's only the extra profits after that level of profit that get taxed at 10%. And it is being phased in from April 2013 to April 2016, but companies are picking this up. We've got at least half a dozen claims on the go at the moment for companies that have got patents, and we're running through the numbers at the moment. So there are a lot of companies where it is worth it, even though it's being phased in gradually.
Just ask about that.
Yeah.
If you're getting income from licensing of patents, is that pure profits for 10%?
Potentially, yeah. Yeah, that would all be patent box profit. Now, what you would then do is the hurdle rate of profit that you need to make is based on a markup on certain overheads that you've got. So you could find that if your company is very heavily based on its turnover on exploiting IP through licensing, and your overheads are pretty low, then that hurdle return is itself obviously pretty low, and most of that profit will end up with a 10% tax rate. So, okay. So who can use it? It is companies only. You've got to have the right sort of IP rights. So in broad terms, a UK patent, a European Patent Office patent, and there are certain patents from other EU jurisdictions which are on an approved list that will cut the mustard for this purpose. But it isn't just about holding the patents. The company's got to somehow have been involved in the development of the IP rights or products based thereon. It's an innovation tax incentive. It's not an asset-based, an IP asset-based incentive. So which sort of companies are we looking at that are likely candidates for being able to benefit? Well, as I say, you've got to have the right type of patents or an exclusive license to those patents. You're likely to need to make trading profits because it's a deduction from trading profits that it's engineered as. You've got to make a reasonable margin on sales of goods incorporating the patented items. As I say, there's a 10% markup effectively on a lot of overheads before you actually get into patent box profits. So you've got to be making a reasonable net margin in the first place. And as we've just discovered, companies that license out their technology and take royalty income are also good candidates for being able to benefit from this. So again, what do you do to claim it? Well, it needs to be claimed on the company tax return. I'm not going to lie to you, the maths behind it, HMRC originally set up to say, well, we're going to do this in such a way that it's a nice, easy calculation. Well, there's several chapters in the tax legislation about how you calculate it, and they're not easy. So somebody was living in a bit of dreamland, I think, when they put that together. It's not an easy calculation, and there's various options that you make through that and elections through that to get the best result. And that's where we're helping companies at the moment to work through how to put the numbers together. To give us a starting point on how to put the numbers together, if you think this is something that's likely to apply to your company, things to think about are, have you got a suitable record of which patents apply to which products? Because that's the very first step. You've got to be able to map those patents directly onto the products. And then obviously you've got to be able to trace the sales revenues through from each of those products. Now, there are a few areas that we've identified in working through this with companies that are probably worth bearing in mind, which I've put a big warning signal on. Patent pending period. Now, I can just see in a few years' time this is going to be an area where lots of people are going to be having a lot of arguments, because the way the rules are set up, you get the patent, you can only claim patent box when you've got a granted patent. You can, however, scoop up into that first year claim, effectively a catch-up adjustment to give you the equivalent of 10% tax rate on the previous 5 years' worth of profits during that patent pending period. But you can only do that if you've ticked the box to say that we want to be included in the patent box. Now, you've only got 2 years in which to tick that box after the end of the relevant period. So 5-year look back, but if you haven't made that election within 2 years after the relevant year ends, those profits are not going to be picked up. So there's no alternative. You've got to look at this while the patent is still pending, rather than wait for it to be granted. Another one that I think people are going off on a bit of a tangent with is patented processes. When you look at a lot of companies' products and they say, oh, it's all, we've got patents on this, the patent is actually on the process by which the product is made, or something to do with the manufacturing process, rather than actually on an item that is incorporated into the product itself. Now, if you're in that situation, yes, you can still get the patent box, but you aren't going to get it on 10% of your sales revenues or your sales profits from the sale of those products. There is a different calculation, and the majority of cases that is not going to be such a beneficial outcome. So if your patent is on the process, then I would suggest you take advice from a patent attorney such as Wyn Jones about whether maybe there's a patent that you can achieve on your product instead, or on developments that you're doing to that product at the moment. R&D tax relief claims have a double benefit in the context of Patent Box. Not only do you get your money out of HMRC for the development work, but they also, ironically, have the effect of putting more profits into the Patent Box. And I won't bore you with how that is, but it is. So if you're looking at Patent Box, make sure that you maximise your R&D tax relief claim. And the last thing is, particularly in the view of what I said about the patent pending period, the temptation might be to say, well, let's just tick the box anyway, can't do us any harm. That would be a mistake, because just as you get a 10% tax rate on Patent Box profits, there is such a thing as a Patent Box loss. If you report a loss for Patent Box, it gets set against your Patent Box profits, which you would otherwise get the 10% tax rate on. So you could end up electing into the regime, not having done the maths, and find that you're in a worse position than by not ticking the box for that period. So just be careful and make sure you do the maths. Or, preferably, get someone else to do the maths. And I know a good person that we can suggest. As I say, seek professional advice. The Patent Box in particular is not an easy area. It's new legislation. Whenever you get new legislation, it's always fraught with problems. And the calculation is not easy, so just make sure you take some professional advice before you do anything. We'll do questions, I think, at the end, aren't we, after Mark? Those are my contact details. There are cards over on the table. If anybody's got any queries, hassle me at lunchtime.